I don't think there was an exact time where I figured out what fire was. I think I figured it out on my own just by um, deciding that our main priority in 2011, 2012, when that's when, my wife and I moved out and we got our own place. We got married in 2010. So I would say that's really the start of the journey, if you will. But I didn't really know about the fire community, the fire movement, the whole 4% withdrawal thing. We just decided we hated debt and let's just focus on paying down our mortgage. But part of the fire is to have no debt, right? It's one of the rules. You should not have any debt whatsoever. So it's once were about to pay down the mortgage that we decided or had to start thinking about, okay, what are we going to do with all this excess this disposable income, right? So that's kind of where, so I know it's not really a direct answer, but at that moment, probably 2016, 2017 is when I started doing more research. And then I guess I encountered what really the fire community was and financial independence, financial freedom. I like that idea a lot, right? Not being dependent on anyone. So I would say that's pretty much the journey towards fire. It wasn't like, we were working and 9 to 5 and we discovered fire, like that's all about. But we just stayed in our lane, focused on paying down the mortgage, going to work. We focused on our careers a lot, not really investing. I was just maybe playing a little bit the stock market. I was actually doing some swing trading from 2011 to 2017. More successes than failures overall, but still lots of time wasted, lots of energy wasted. But overall, it was a good experience. But the main focus during those 7 years was paying off the mortgage, really. What I liked about it the most and still like about it the most is really the freedom aspect of it, not being dependent on anybody, right? When you have a job or when you're dependent on your parents when you're younger and you're dependent on friends and family, it's just, I don't know, it's like a ball and chain. You just want to not be dependent on anything, right? So I was always, ever since I was young, I was a very independent kid. And I just hated being dependent on other people, on other entities, whether it's a job or your corporation, whether it's the government, whether it's your parents, your friends, family, whatever. So for me, that was really, it's just to be free. It's just not to have the dependency on other things, on other people. What happened with us is that once the mortgage was about to be paid, I started doing research. Okay, what exactly are we gonna do with this excess income? And then I saw a clip of Kevin Leary talking about dividend stocks, and then, if you just start googling dividend stocks, you'll see passive income, you'll see financial independence, you'll see all those buzzwords, right? So in Canada, especially, a lot of the best stocks are dividend stocks. In the US, it's not really like that. The best stocks, the best performing stocks are more the growth stocks, right? In Canada, the best stocks that have the best growth and total returns are typically the dividend stocks. So we're talking about the big banks, obviously. Those are, always been some of the best performing, still are. They all have nice big growing dividends. So that's basically how I started into I guess you could say, dividend investing, income investing journey of just generating cash flow. Because I did the whole swing trading thing, trying to buy low and sell high, and I knew how much of a waste of time that was, how much time and energy it could drain on you. And I realized pretty quickly that the people who really always make good trades are probably people that have inside information, that are cheating, or just are spending an inordinate amount of time. And even most of those people get it wrong anyway. So looking at percentages of outcomes, you're just better off buying and holding. But I did like the fact of getting consistent cash flow. So that's when my wife and I decided to go all in and sell the condo. That was where we put all our money, basically, because 2017, 18, 19, I guess you could say, was our test run, where we were still working. We had a lot of excess income. disposable income rather, and we didn't have a mortgage. So we were investing a lot in the stock market and buying dividend stocks and trying out all these things. And eventually we got to $1,000 a month, and we saw that it was consistent, very, very consistent. And we said, hey, this works. What would, then we started thinking, okay, if we just sell our paid off condo, invest it all, how much money can we actually make a month? And we determined that, holy crap, that's basically, we would be financially independent. The amount of passive income we would make every month would exceed not by much. I think our monthly expenses, if I remember correctly, this is a long time ago. This is before the big COVID print. So it's probably about $4,000 a month. We could live pretty comfortably in Montreal. And if I think it was 4,500, so we even had $500 extra. That's what we decided to do. My wife quit her job first because she didn't like it. She wasn't happy at work. That was at the end of 2019. And I had quit my job 8 months later, 10 months later, once the YouTube channel started going, and we figured, we could focus on this instead of jobs. So when we went all in 5, 6 years ago, whatever it is now, the end of 2019, I had a mishmash of stuff: covered call ETFs, single REIT, single stocks, closed-end funds. And the COVID crash actually happened 3 to 4 months later. We went all in. So we talk about bad timing. That was the worst timing in the world to go all in. So I'm actually extremely happy that in hindsight, that happened, because I learned, in investing, if you have a 10-year bull market, you're not going to learn anything in 10 years. If there's a 3 or 4 or 5 month crash, you're going to learn the most you've ever learned the past 10 years in those 6 months. You're really going to learn what your portfolio is made out of, what your guts is made out of, right? You're going to learn a lot during a bear market or a crash. So during the COVID crash, it was pretty brutal, pretty intense. I mean, I think my portfolio, the value was down maybe 30, 35%. But the whole reason I started investing this way is exactly for this purpose: not to care about the fluctuations of the stock market or of the value. Just like a long-term real estate investor that's deciding he's going to buy a house or a building as an investment or as a home, and he's going to hold it for 20 years, he's not really going to care, he or she is not really going to care about the month-to-month fluctuation of the real estate market of prices, because you're just buying and holding this asset for the long term. You're making it's not really a big bet, it's almost a sure bet that long term the prices are going to go up, right? Because if you understand inflation, you understand that asset prices do go up over time in the long run, but short to medium term, there could be crashes, there could be whatever it is. That's one of the main reasons I was doing this strategy in the first place, because in my head, I'm just going to buy all this stuff, I'm going to hold it forever, I'm not going to sell anything, I'm just going to collect the income. And the value of the portfolio is going to fluctuate. That doesn't bother me. And I'm just going to reinvest all the income that I don't need on a month-to-month basis, and just keep growing and growing and growing that way, right? So that was a big lesson learned during the COVID crash. But what I did learn is that because this style of investing is really based on the income, right? You don't want your distributions or your dividends to be reduced or cut or eliminated. And what ended up happening was, there was quite a bit of stocks that I had that reduced their dividend, reduced their distribution, and cut it altogether. So that's when was the trigger to do more research, and slowly throughout the years, pretty much, migrate everything to covered call ETF wrappers, which here we are today. My portfolio is 100% covered call ETF. A certain type of covered call ETF, leveraged ones, right? And we could talk about that why later on. But once you start learning what covered call ETFs are, and essentially what a covered call strategy is, you start learning a bunch of stuff. And the biggest thing you could learn is that when you do a covered call strategy on anything, and covered call ETF is just an ETF that's doing it for you, basically. That's running the covered call strategy. But if you could do it yourself too, just like you could buy and trade stocks, and pick your own stocks as well instead of buying the ETFs, it's just a wrapper. But what you discover in principle is when you do a covered call strategy on anything, whether it's a single stock, a group of stocks, an index, compared to just holding that stock or that group of stocks or that index by itself, you're always going to underperform long term. You're always going to have less total return, right? You're going to have that income, that's great. You're always going to have less total return. So I consider myself still young, even though I feel old sometimes. But I'm 40. I'm going to be 41 soon. But even back then, total returns is something that is very, very important to me. I also want good total returns, good performance, as well as the income. So that's when the lightly leveraged cover call ETF started coming out to try to minimize that gap or close that gap that all cover call strategies and all cover call ETFs have. They underperform just holding the asset on its own. I don't think there's a weakness anymore. I think the biggest weakness is not understanding the strategy and not actually following it, not being, and this goes beyond covered call ETF investing. I think it goes for investing in general. A lot of people just think they're investors, but they're not. They don't think like investors. They don't behave like investors. Investors is for the long term, right? You shouldn't be bothered by day to day, month to month price fluctuations and movements. People lose their minds over it. They give up. They sell. That's the whole danger. That has nothing. That's just investing in general. But as far as I could tell, just like, for example, buying and holding major indexes and holding them forever can never be wrong, right? I think most people will agree on that. I don't think I never met someone who invested in an S&P 500 or a Nasdaq 100 or a TSX 60 or even something like XEQT or VEQT where you buy the whole world, and after 5, 10, 15 of just holding it for like 5, 10, 15 plus years, that they lost money. You'll never meet a person, right, like that. It's pretty much guaranteed to win if you just stick to the buy and hold principle. The same thing really applies for income investing. It's not really any different, right? So my strategy is actually very, very, very close, even though it seems like it's completely different because it's income oriented, it's covered call ETFs. It's 98% similar to someone who just buys the indexes and holds them for 10 plus years, right? I'm just getting my return in a different way. They're getting it completely with capital appreciation. There is a little bit of dividends, but normally when you buy an S&P, Nasdaq, you're going to reinvest the dividends because it's only 1% or less, right? So they're getting their return with capital appreciation. I'm getting it with a mix of income and capital appreciation, but mostly with the income. But for example, if you just drip everything, there's almost no difference between the two strategies. And the proof is in the pudding. That's why I do total return comparisons all the time. And the easiest things to compare are really like S&P 500 ETFs versus S&P 500 covered call ETFs, because the asset is the same, the strategy is different. And what you'll notice is if the covered call strategy is modest, they're not doing too much covered calls, they're not giving up too much of the upside, and there's a little bit of leverage, you're actually getting very similar total returns to just the guy who has the S&P 500 index. So to me, those types of covered call ETFs are the holy grail, my opinion, because you could have your cake and eat it too. You could have your income and also get the same performance, similar performance to the other guy. And there's a lot of psychological benefits from doing what I do versus just holding the index funds. But for the record, I think index funds are fantastic. If you just buy index funds or an XEQT or VEQT or whatever, you're not making much income. You're not making much yield, right? 1, maybe 2%. So unless you have $20 million or $10 million, you can't really live off of it. You can't really gain your financial independence off of that. Now, the whole FIRE movement says that you should buy these index funds and sell them off gradually, and that's where the whole 4% rule comes in. That's just tedious. It's annoying. I'm a very lazy person. I've always been one. I just want something more automated where I don't have to sell anything. I don't have to manage my selling and anything like that. So basically, have your cake and eat it too. I'm getting the income. I'm getting consistent monthly income, but I'm getting the similar return or similar performance if I would reinvest those dividends as someone who has the index funds. But where my advantage is I never have to sell anything, whereas the index fund investor has no choice but to sell later on at some point to realize any profit and realize any gain. Yes, of course, they could sell it and switch it to an income oriented S&P 500, a covered call, right? But they're going to have to figure out a time when to do that. They're still going to have to sell, which means they're much more inclined to look at the stock market, look at stock prices every day and be more worried. There's always that little thought in the back of your head, when do I sell? When do I sell? How much do I sell? Let's say you're the year of your retirement, you're ready to sell, start selling, the market crashes. You feel bad selling, you don't want to sell. So all these problems are avoided with my strategy because you're buying and holding. Essentially, you could buy and hold it forever. And every month you're getting those dividends, you're getting those distributions, which comes from the capital, it comes from your investment, and you have the flexibility of doing whatever you want with that cash flow. Whether you spend it all to live off of, whether you spend half of it to live off of and reinvest the rest, whether you spend 75% of it and you take 25% of it and reinvest it in something else that you see as a good opportunity. So this system has a lot more flexibility. And I never worry about stock prices because I'm technically never selling my funds. I don't need to sell them. And if you are in your 60s and 70s, I know people that are in their late 60s and 70s that are really, they want to enjoy life, they actually want to draw it down, they could simply decide not to reinvest. They'll get their cash flow and just spend all the income. But for me, that's still in a growth or accumulation phase, where total return and growing my income, growing my net worth is the top priority because I have business income now, so I don't need the income. You could reinvest everything. You avoid the drawdown problem. There's a huge industry in Canada and the US just to help people, financial advisors, financial planners. What is most of them get hired for, a lot of them, to figure out the drawdown plan during retirement. So with what I do, I don't need any of these people, right? I don't have to pay the fees. It's kind of like an automated drawdown system, if you will. And if you understand what call options are and covered calls are, you understand that the income is essentially eternal, right? Unlike dividend income, which could be eternal also. There's companies that have been paying a dividend forever and never cut it, but there's always a risk. Whereas covered call premiums, it's not based on the company's profits or anything like that. It's agnostic to that. It's just the options market. So that's also what I feel is another advantage, where dividend investing has that negative. You just never know. A dividend stock could get cut. Another big negative I feel is that dividend investors versus what I do, cover call ETF wrappers, dividend investors have to only invest in dividend stocks, right? So in a lot of the great high performing stocks out there don't have dividends. So they don't have those in their portfolio. They miss out. So what I do, you could just wrap a NASDAQ 100. You could wrap an S&P 500 where a lot of the stocks don't have dividends, and do a cover call strategy on that. So I'm not limiting myself only to a certain amount of stocks. You could buy basically whatever you want. Income or growth or dividend strategy. The TFSA, by far for Canadians, by far, it's not even close, is by far the best and biggest and most beautiful gift, and the only gift, in my opinion, that the Canadian government has ever given you. When you go to school, I think in kindergarten, even the first four letters you should learn is not ABCD, is TFSA. That's how important I think it is. All Canadians need to understand how powerful, how amazing this tool is for your net worth, for your family's net worth. I mean, It's the only thing in Canada that's tax free that you don't have to pay taxes on. Your salary you have to pay taxes on a lot, obviously. Your RSP, eventually you'll pay taxes on it. Your real estate, you pay taxes, whether it's rental income or capital gains. Besides illicit activity, the TFSA is the only way not to pay taxes in Canada. That's why there's such a very strict limit on how much you could put in. The government's not stupid, right? It's the only place that you could put money in. Obviously, you don't want to go over your allotted contributions, but I think, let's say if you turned when did it start? I think it started in 2005, I believe, under the Harper administration. So if you're 18 in 2005 or past and you never touch your TFSA, you have about 109, I believe it's $109,000 of TFSA room. So what that means is that any money that you put in there, you could invest it. You could just let it sit there, big mistake. You could put it in a cash savings GIC or a GIC, my opinion, complete nonsense, big mistake. But you could put it in an index fund, you could put it in dividend stocks, and all the growth and all the income that it generates is completely tax-free, even when you take it out. And the cool part is, the most important part of it is, whatever you take out, you could put back in the following calendar year. So it's a very, very, very powerful tool for growth investors and income investors as well. Because I know people that have $2, $3, $4, $5, $600,000 of value in their TFSA. And people, first question you get is, I thought the limit is 109. How do they have 600? How do you have 500? No, the limit is only on the contribution amounts. The limit is only how much you could put in within. I know someone who has $1 million on their TFSA. If you make smart investing decisions, and time is always your friend in investing, you could grow that to 2, 3, 4, 500,000 easily. And then, if you're generating income in there, if you're generating growth in there, whatever comes out is tax free. So it's by far the most powerful wealth building tool in Canada. Second best would probably be the RSP, but by far the TFSA is the most important thing. It's the first account you should open, right? As soon as you turn 18, the first $6,000 to $7,000 you want to invest. The best present a parent could give their 18-year-old son or daughter is $7,000 for their first TFSA account. Put it in an index fund, put it in S&P, put it in something, whatever, and who knows what it's going to do in 20, 30, because all the compounding, all the growth, all the income, it's all tax-free. Investing is really a long-term, very boring thing. It's like, compare, if you do a real estate analogy, speculating would be, there's a bunch of those shows on TLC, I guess. I don't know if they still do them. Flipping houses, right? You're buying houses, you're renovating them to make a quick flip, a quick buck. That's speculating. For me, that's gambling. It's high risk, high energy, a lot of time and energy. Investing is you buy an apartment building, you're gonna hold it for 20 years and collect the rents as you go, right? So investing is really a long-term, it's a buy and hold long-term thing where you don't really care about the price fluctuations day to day, month to month. You're not obsessed over that. What you should be obsessed is with your time frame, and try to buy the top quality assets, or the assets that you feel are going to perform best over time, while taking into account your risk or volatility stomach, right? How much you could take. So for example, for me, in the stock market, I think a good starting point is a good base, boring starting point would be something like the S&P 500. Like, to me, I would never go less risky than the S&P 500, because the risk of the S&P 500 makes me fall asleep. Like, we're talking 15 volatility. It's, really boring. It's 500 companies, automatic diversification, big companies. Yes, they're headquartered in the US, but they have international revenues. You even have like companies that are not really US based in there. So to me, it's just the easiest, most baseline thing that you could hold for 5, 10, 15, 20 years forever, right? That's investing. Speculating is really you're following trends. You're looking at what's popular. You're following the trend. 6 months ago, it was gold and silver. And at one point it was Bitcoin. Now Bitcoin and gold are low, and everyone's talking about this SpaceX IPO. And then 3 weeks ago it was AI stocks. This is short-term gambling, getting in, getting out to make a quick buck. It's basically not really much different to me than going to the casino, being a player to the casino. I rather own a tiny bit of the casino. That's investing. You buy everything. What I mean by everything, you could buy bonds and stocks and real estate or REITs, but as you gain your experience, you start determining what you need and what you don't need. So for example, for me, I have no more REITs and real estate anymore. I have absolutely no fixed income, no bonds. I don't really have direct gold exposure. I do have some commodity producers. So I'm okay with the risk of stocks in the stock market or equities, because if you go back 100 years and 10 years and 20 years and 50 years, 100 years, it's the best performing asset is equities, it's stocks. So everyone needs to make their own decision on how much volatility they could take. And then you decide what to deploy your capital, what assets you want to deploy them into, whether it's 100% stocks like me, well, it's like 100% stocks and some Bitcoin. Everyone needs to make their decision with that based on the volatility that you could stomach. But to me, my personal opinion here, the S&P 500 is really something very easy most people could stomach. Like if you can't stomach the S&P 500 volatility, I think it's better that you work on that, on yourself and on your emotional whatever, than looking for other assets that have less volatility, because you're going to make way less returns and way less growth over time. That's my personal opinion. I think the S&P is a good baseline. It's so boring for me that I don't even have an S&P. I went to the NASDAQ 100, which is just a tad higher volatility, a little bit more concentrated in tech stocks. So that's really the difference between investing and speculating. Speculating, you're chasing the trends, you're investing in individual stocks because you read something and and whatever. My experience, that doesn't really work. You'll get lucky sometimes, but over the long run, you calculate all the time and energy you spent on it versus just if you would have just bought a NASDAQ 100 or an S&P 500 and just kept it, you would have probably done even better. If you manage to beat the S&P 500, some people can, like 5% of people can, then there's all the consideration of the time and energy you spent as well. A lot of people forget about that. So that's what I feel. Most people think they're investors, but they're really thinking and chasing like a speculator. I'm a pure investor. I don't look at stock prices. I don't really care. I just keep buying and holding, and I just keep buying no matter what the price is every single month, just mechanically and robotically without emotion. Once my wife quit her job and we were, and we sold a condo, we're financially independent, and I was planning to quit my job eventually. It was going to happen. Everyone was asking us, it was at the gym. I mean, we go to the gym. We went to the gym almost every night. So we had our friends there, and we were always talking, and we were telling them this. And what do you mean you quit your job? You're in your 30s. Like, what do you mean? How are you doing this? How are you generating the cash flow? And we would explain it to them, and it would take a long time. And then by the end of it, they wouldn't really understand. And it was like, there goes my whole workout. So we had the idea, well, why don't we just put it on YouTube so we could just send people there? That was the spark. And because my wife wasn't employed at that time, she had quit her job, she had more time on her hands. So she's like, why don't you film the videos and I'll do like the editing? And because we were in the IT field, but we didn't know anything about media or video editing, but we figured that's kind of tech related, we'll figure it out. And eventually we did. And that's how the YouTube channel started. We started by showing people or trying to educate them on dividends and dividend investing and what we're doing. And I think the first video that really blew up our channel, which took 6 to 7 or 8 months, I can't really remember, was the third portfolio unveil, where I unveiled my entire portfolio. To that day, the now I'm on portfolio unveil 60. But number three, I think, still has the highest amount of views. I don't know, was it the thumbnail, the title, some, you just never know with YouTube. And that's when the channel blew up and we started getting monetized, and it kind of became kind of like a little side hustle, which gradually grew and grew and grew to kind of a full-time business for us, right now, that we put our heart and our love into. But in terms of how it's impacted my investing style, nothing. It's really, the channel is almost like it's tracking my personal investment journey. I'm not a special individual. I'm like everyone else. I'm on my own investing journey, just like everyone else, learning and modifying and keeping track of the new funds. So this channel is, it's about education, obviously. It's about getting the information from the fund managers, but it's also just recording my personal journey. Sometimes I feel like I'm talking to myself when I'm doing the videos and just sharing my mentality and why I'm buying this and how I feel about this market crash, and like I don't care, like who doesn't make a difference, you know what I mean? So it's kind of like our journey plus education plus that's what it's become. So that's how it started, and it's evolved from there. And my wife and I were always very entrepreneurial from the start, even when we met and we weren't even going out. We met at CGI, the IT company that we worked for. We were hustling and bustling together even before we were going out. Like we were getting stuff from China and reselling it on eBay. I was a very entrepreneurial since I was young, and so was she. So this was kind of a natural evolution, natural fit for us to focus on the channel now. That's what we do basically, but at our own leisure, at our own pace. The last thing I will maybe leave you, if someone is a bit newer, there's no right or wrong when it comes to investing. If you learn this right away at the beginning, it'll save you so much time and energy, because everyone I always see chases or has the question in social media, what's the best ETF for this? What's the best stock nowadays? What's the best? There is no best in investing. There's only what's best for you. So I rather you spend time on that, figuring that out, than trying to figure out what the next big hit is.